Good morning and welcome to the Commodities Institute podcast. I'm Emily Costa. Today is December 17th, 2025, and as we head toward the end of the year, the commodities landscape feels anything but calm. There is a growing sense that geopolitics, trade policy, and supply chain fragility are converging again, just as markets were beginning to price in stability. Let's start today in oil, but not where you might expect. Over the past 24 hours, the market has been reacting sharply to a dramatic escalation involving Venezuela. President Donald Trump has announced what he called a total and complete blockade of sanctioned oil tankers entering and leaving the country. The language alone rattled traders and prices responded immediately, with crude benchmarks bouncing higher after touching their lowest levels in nearly 4 years just days earlier. What's important here is not only the immediate price move, but that the uncertainty around enforcement. A blockade in traditional international law is considered an act of war. That raises serious questions about how far the United States is prepared to go and how other nations, particularly China, will respond. China currently takes more than 500,000 barrels per day of Venezuelan crude, and while that volume represents a small share of its overall imports, it is crucial for Venezuela's survival. There is already an effective chilling effect underway. Tankers are sitting offshore, loaded but unwilling to sail, as owners and insurers weigh seizure risks. Add to that a cyber attack on Venezuela's state oil company systems, and exports have already dropped sharply. If close to 1 million barrels per day of supply is effectively stranded for an extended period, even a well-supplied global oil market starts to feel tighter very quickly. Analysts are quietly modelling a scenario where prices rise by $5 to $8 per barrel, not because demand is booming, but because geopolitics is removing barrels faster than spare capacity can respond. Now let's pivot to metals, where Europe is facing a very different kind of supply shock. The looming shutdown of the Mozal aluminium smelter in Mozambique is sending ripples through global aluminium markets. This plant alone accounts for nearly 1/5 of European Union primary aluminium imports. When it goes into care and maintenance in March, Europe will be forced to replace hundreds of thousands of tons of metal almost overnight. That challenge is compounded by outages elsewhere, including reduced output in Iceland, and by policy changes such as the European Union's carbon border mechanism, which effectively taxes high-emission imports. The result is a rapidly tightening market. Aluminium prices are already hovering near 3-year highs, and physical premiums in Europe have surged. Buyers are now scrambling to secure alternative supply from Canada and the Middle East, regions that are well positioned to fill the gap, but at a higher cost. This is a classic example of how energy policy, climate regulation, and geopolitics collide in metals markets. Aluminium is critical for everything from electric vehicles to packaging, and disruptions here tend to ripple outward into manufacturing costs and inflation pressures. Staying with metals for a moment, Guinea is also reasserting control over its vast bauxite resources. Talks are underway between the government and Emirates Global Aluminium over a potential supply agreement after Guinea revoked the company's mining license earlier this year. Guinea holds the world's largest bauxite reserves, and its actions reflect a broader trend across resource-rich nations seeking greater state control and higher revenues. For aluminium producers, this adds another layer of supply risk at a time when demand for low-carbon metal is accelerating. Let's turn now to agriculture, where trade policy is quietly reshaping flows. China has sharply reduced tariffs on European Union pork imports after an 18-month investigation. While the final duties are far lower than initially feared, they still represent a meaningful tax that will squeeze margins for European producers. For China, the move comes at a time when domestic pork prices are falling due to oversupply and weak consumer demand. Higher import costs could offer modest relief to local farmers while keeping trade tensions with Europe simmering rather than boiling over. Grain markets are telling a different story. France has lowered its forecast for wheat exports outside the European Union, citing fierce competition from Argentina and Australia, both of which are harvesting large crops. At the same time, demand within Europe has risen, particularly from livestock feeders responding to reduced maize imports. This internal rebalancing highlights how global abundance does not always translate into easy exports, especially when freight routes and relative pricing shift. Speaking of freight, Kazakhstan has already shipped more than 3 million tons of grain since September, underscoring the importance of Central Asia as a supplier to neighbouring regions. Meanwhile, South Korea is back in the market for large volumes of feed corn, signalling steady demand into early 2026. These flows matter because they shape dry bulk shipping demand, even when headline freight rates are under pressure. Now let's touch briefly on carbon and power, where long-term transitions continue to clash with near-term realities. Global coal demand hit a record high this year, driven by power needs in Asia and policy support in the United States. Yet the International Energy Agency expects demand to plateau and slowly decline by the end of the decade as renewables, nuclear and gas expand. The key variable remains China. Any delay in renewable integration or faster than expected electricity demand growth could keep coal consumption higher for longer. In Europe, offshore wind is at a crossroads. Poland is launching its first competitive offshore wind auction with generous price support, a stark contrast to failed auctions elsewhere on the continent. If successful, this could restore confidence in a sector battered by rising costs and policy uncertainty. For commodities markets, the outcome will influence long-term demand for steel, copper, and critical minerals tied to renewable infrastructure. As we wrap up today, what stands out is how interconnected these stories really are. Oil blockades affect inflation, aluminium shortages affect manufacturing, pork tariffs affect farm incomes, coal and wind policies shape metal demand, and freight quietly underpins it all, moving commodities from surplus regions to deficit ones. Markets are once again being driven less by pure supply and demand and more by political decisions, regulatory frameworks, and strategic competition. For anyone operating in commodities today, understanding these linkages is no longer optional. It's essential. That's all for today's episode of the Commodities Institute podcast. If you found this episode valuable, be sure to subscribe, share, and leave a review. I'm Emily Costa. Thank you for listening, and I'll be back tomorrow.